Okay, Rooster's rules to managing your investment portfolio. There is no one-size-fits-all investment strategy. Time horizons, risk tolerances, income needs and emotional capacities differ across investors. Yet while tactics may vary, the underlying principles that lead to successful investing remain remarkably consistent. They revolve around applying rules. Okay, so first of all, the mindset, the dating pool. The market is massive. Think of the stock market as a giant city full of single people. Fresh options arrive every single day. The balancing act. Your portfolio should reflect the type of lifestyle you want to achieve. A balanced risk profile would have a mix of steady partners, reliable, low drama, earning an income type assets. And an aggressive risk profile would need high maintenance flings, hot body, no job, fun, but volatile growth sector companies with huge upside potential for marriage maybe. And then move to a balanced lifestyle if you want. Okay, so the important parts. The relationship rules. Rule number 1, don't fall in love. The most important one, and even the Rooster, he has his soft spots, like with KCN, probably silver in general. I'm sure a lot of CSL people fell in love, and I'm 100% sure you've got your own stock that you're just in love with and will never sell. So keep your heart out of your decision making. Treat every relationship like a strict business contract based purely on performance. Rule 2, cut the cord, aka use a stop loss. If a relationship isn't meeting expectations, break up. Never average down. That's the financial equivalent of moving in together to try and save a failing relationship. Stop making excuses. Oh, but they have a great personality deep down. Or they promised I'll get a job next month. If the chart breaks previous lows or trend lines, cut them loose. If you can't handle a breakup, stick to cash and marry your savings accounts. Rule 3, re-entry. You can get back with an ex, but only if they completely cleaned up their act. If the chart structure fixes itself and turns bullish again, you can safely jump back in. Rule 4, the 21 target. Aim for a harem of roughly 21 positions globally. That's ASX and US, basically. So that is 7 days a week for breakfast, lunch and dinner. 7 times to 3, I'm sure you get that. Fewer than 21 means a couple of bad relationships can ruin your whole week, aka your total portfolio return. More than 21 dilutes the magic from a couple of good flings, and you won't remember by the end of the week, aka that doubler did not change my total portfolio return. Rule 5, don't chase. Never run after a stock that has already skyrocketed. That's like chasing the most popular lady in the room with guys paying for whatever she wants. Wait for tomorrow's fresh batch of options. Rule 6, spot the peak. Know when the passion is gone. Exit on technical red flags like shooting stars, rounded tops, broken trend lines before things go downhill. Okay, application to your portfolio. So this is just an example. The position gap. You currently have 10 active holdings, leaving you 11 short of the 21 partner sweet spot. You're a little too concentrated. The toxic weight. Because you're under 21 positions, single stock drama hurts you too heavily. Look at Palladium. It makes up 20% of your portfolio and it's down 30%. So that's minus 6% of your total portfolio return. 20 times 30, hope you get that. So the other 80% of the portfolio needs to make 7.5% just to break even, or make 20% to return 20%, 10% on the whole portfolio. Okay, so just to help get the gist of this. So the asymmetry of loss. So if you lose 20, you got to make 25. If you lose 40, you got to make 67 to get it back. Lose 60, 150. So that's just to recover. So this is why cutting relationships, if they're not working, is important. The ETF shortcut. If managing 11 new individual relationships sounds exhausting, adding just one broad market ETF, also known on this channel as a tank, example the IOO or MVR ETF, counts as 10 standard positions. Or a theme-based ETF, aka Ninja, example GDX Wire, counts as 5. Think of it like a steady, predictable group date to safely hit your 21 target. However, you may be disappointed by the lack of daily spark. A portfolio of individual global shares, aka full Ninja, is more likely to outperform, but takes on more commitment. All right, and there's our little picture of the tanking Ninja. So just to cover off on that last point, so I've got 4 or 5 model portfolios that sort of cover this span. So this is our Ninja ASX 300 model portfolio. So this is full Ninja. So it's basically at this stage, what are we, the 14th of June, full of metal stocks. They're all ASX 300, so there's no hot copper. They're all big boys. But it's up 100. So this is from April last year, 154%. Okay, then we go down. So then we have our US ETF model portfolio. So these are not full ninjas, but ETF ninjas. So currently we've got all these are the ones, and it's done 129%. So these are all started at the same time. And then we have the ASX ETF portfolio, which is just ASX ETFs, and that's 187. So you can see as we sort of come down there. And then only recently I started the tank ASX. So this is for the balanced person. So I only started this month. only of 1st of May. So 6 weeks ago. So and it's already up 11, 12%. So it's not meant to do that, but it's just full of dividend paying stocks. You can have a look at them all there. So I can't really say what the 1 year return is, but I'm pretty confident that the Ninja ASX 300 will outperform. So depending on what type of relationship or lifestyle you want, that's the idea, is to just pick and choose. It's my job to, so I aim to keep the holdings all fresh and relevant. If they've peaked, they get removed and replaced with some other person. Same if they're not performing, they get culled. All right, I hope that just helps you building your portfolio. Have a good one.